Let's get to the floor show. That guest is SMBC Americas chief economist Joe Lavorgna, who also served as senior counselor to Treasury Secretary Scott Bessent. Okay, before we even get to your theory about the rate hikes or your belief that we will see a rate hike as in Wednesday, let's just look at the macro picture here and what one single entrant in the Chinese stock market is doing to our markets, at least the sort of the growth area, and that would be the memory chip makers.
Yes, but these stocks have gone up massively and historically are highly valued. That's not to say they won't continue to do well, but the fact that it's a new space, it's an arms race, so to speak, within the sector and with our competitors overseas, it doesn't really surprise me, Liz.
Why not? Because
when you get these sort of moves, even like a 3-4% move on these stocks that have moved so aggressively, I mean, this is, the embedded implied probability of these securities moves quite, it moves around a lot. So I'm not a single stock picker by any means, but it's not surprising to me when you get like these sort of parabolic moves. You're going to get these pullbacks, which will feel bad. But broadly speaking, on the macro side, the outlook for tech spending is excellent. And this isn't like the late 1990s. It's a different era. And these are real companies that are spending a lot of money, and it's having these spillover effects downstream to these other semi makers and so forth.
Yeah, let's look at some of the semiconductor names, not the hyperscalers, because that's sort of a different piece of this, but we should be looking at not just the memory chip makers, but the semis, and particularly maybe even the semi-equipment makers, ASML and Applied Materials. There apparently is a Chinese company that's muscling now into that region, into the chip equipment companies. So China is a thing. It's definitely a force. I think you could agree.
Well, you're seeing it politically. I mean, the Trump administration put tariffs on in the first administration. The Biden folks came in, left those tariffs in place, tried to put controls on what was exported. Trump administration comes back in, more tariffs. I mean, and from a bipartisan perspective, China is generally perceived as a key competitor, a peer competitor, a strategic adversary of the U.S. So I can understand how investors get nervous because, as I said earlier, it's an arms race. A lot of money's being spent. And I believe that for many in the U.S., it's an existential crisis and that we can't lose.
We should put up the Alex Karp promo because he's coming up soon. He has been warning about China, and yet he signed this open letter. We're going to talk to him about it. But the open letter, in essence, says, hey, let China models from the AI space run free. But this is something that your former boss, Treasury Secretary Scott Bessent, is now looking at to ban or at least restrict. Which side do you fall on this?
Well, my open letter would be to the Fed Chair, Kevin Warsh, on why he should raise interest rates. So I'll leave the open letter for you to talk to Mr. Karp about. But getting onto the Fed for a moment, to me, that's also interesting. That also may be a factor why some of these stocks are down, because the market is still pricing a relatively high probability of a rate hike. That does take liquidity out. It may not just be a new entrant or competitor from China, but the fact, hey, if the Fed's raising rates, there might even be some residual fear there as well.
Okay, Wednesday, you believe that there is a good chance there will be a 25 basis point hike by Kevin Warsh, the new Fed chair that President Trump put into place. Why?
A couple of reasons. The first is that the Fed, if you recall, last December, Jay Powell was able to get a consensus barely to cut rates. There were 3 people that voted against a rate cut. That was done at the time because there was fear the labor market was going to soften, and they wanted to guard against that unwanted weakness, having cut twice earlier in the few months earlier. So here we are now. The economy is doing very well. These companies, as you alluded to, are generally doing excellent, spending a lot of money. The labor market's a lot better. We're past the point of stabilization. We might be accelerating on jobs. The inflation outlook is still very fraught. It's uncertain. The market's pricing a reasonably high probability of a move. Why wouldn't you take that opportunity, do it now, get it out of the way? You're not going to be accused politically of a hike, and long rates probably rally.
President Trump won't be too happy. He's made it
Maybe.
so clear.
Well, but if he says, if the long rate rallies, if he says, if I go to Mr. President, Mr. President, look, if we hike rates, we can get long rates lower and we can get more money in people's savings accounts to give to consumers. That's a good story. But the reality is when Kevin got the job in June, when he finally took over his first meeting, there were 9 people that wanted a hike this year, 9 that didn't. And you could argue over the past 6 weeks, the evidence for hiking is still there. So if he wants to do it, he can do it. And he's going to ultimately act what's in the best interest of the economy and the Fed as an institution. I don't think he's going to worry so much about what the president thinks.
You look at Treasury yields, they are coming down, but mortgage rates are at an 11-month high. So that doesn't make the president thrilled either. And that whole piece that matters to Treasury, which is helping people afford a mortgage to buy a home. So do you look at certain sectors as far as investments and say, I'm going to stay away from this, I'm going to go into this?
Well, the thing is, the housing market's weak, though, and the administration has tried to do things to improve affordability. I think it was too little, too late. But, housing is very important in terms of GDP. It's only 3% of the economy. So you can't set monetary policy to the 3%. Manufacturing, which I know is something very near and dear to the president's heart, we've had now 6 months in a row where the ISM manufacturing survey has been well above 50. So sentiment there is improving. So if you're the Fed, you're Kevin Morris, you're looking at the broad panoply of data, and you're saying, okay, where are the risks to the economy? Yes, mortgage rates are high, but the rest of the economy is very healthy. And that's what the Fed has to respond to. It's highly, highly unlikely inflation, which has been above target for nearly 6 years now, is going to magically get back to where it needs to be without the Fed, at least, as they say, leaning against the wind and raising rates a bit.
Looking holistically at the picture, hopefully that is what the Fed does. We'll see you on Wednesday.
Thanks,
Thank you,
Liz.
Joe.
Thank
Good
you.
to see you. Joe Lavorgna.